All right, welcome to the bonus material. Here are some extra patterns that I want to share with you and some extra techniques that I want to share that are a little more advanced. So we're getting into some things here that are beyond just the basics. Some occur quite often, some not so much. They're considered advanced because you need to, they add more information. They can be very helpful, but at the same time, anytime you add more information, you're, in essence, kind of complicating things simply because you have more to consider, more information to process, if you will. So for each trader, it becomes an individual question as to how much information you are going to use in your trading methodology. And neither me nor anyone else can tell you how much information you should use in your own personal trading methodology. Trading is ultimately a personal thing. You have to make those decisions. And it's based on how much and how fast you can process that information. So, the basic rule is, like Einstein said, you want enough information, but not too much. So you want enough to give yourself a probability edge in the market, but you don't want so much that it clouds the main issues, distracts from the primary points, or just creates utter confusion. I see people who have just so many things on their charts, and they think, what that normally is, it's a craving for certainty, which is a battle that we all have to fight, because there is no certainty in the market. People rail against that idea. They do not like that idea. And that's cool. That's part of the quest for security that we all have, the nesting instinct, if you will, the survival instinct. So it's really instinctual, and that's what makes it so challenging to overcome. But when it comes to the markets, you must overcome it, otherwise you will lose. I don't care what trading methodology you're using. You've got to overcome that issue. And so, again, this is where everyone's a little different. Some people, they're big risk takers, and maybe too much of risk takers, and they need to pull that back in their personality in order to become an effective trader. And then somebody else, their personality type is just ultra conservative, and that's going to hurt them too. You can't be too conservative with trading. There is always risk in every single trade that you have. So you're always living on the edge, so to say, when you're trading. It's not a very secure profession to be in, quite honestly. It's always up to your next performance. So, I liken it kind of to the entertainment industry, like acting or being a professional athlete. Your income is dependent upon your performance, and when your performance goes down, that's it. You're out. Over and out. And a big part of your performance, even with athletics, even though it's built on physical prowess, is still mental. I mean, no secret. Everybody knows that the game between your ears is one of the biggest things when you're a professional athlete. And so too with trading. And again, this is well-known information. People know the information, but they haven't really assimilated that into their behavior and worked on themselves. So in trading, it's important to work on your technical analysis, your understanding of the markets. That's what most people do. They sit there and analyze and try different indicators and chart patterns and all this stuff over and over and over and over and over and over and over. And they do too much of that. You've got to do some, obviously. You've got to become familiar with the terminology and the basics, and develop a good, solid trading methodology that puts the odds in your favor. But then you've got to work on yourself, and that includes these things that I'm talking about, the emotional issues of risk, of loss, of drawdown periods, of, if you lose $100, what's that mean to you? If you lose $500, what's that mean to you? If you lose $1,000, what's your risk tolerance where you just go crazy and you can no longer effectively perform? What's your attention span? That's going to make a dramatic difference as to which time interval you want to use. People ask me all the time, every day I get this question, what's the best time interval? Well, I don't know what the best time interval is for you. It's an individual question. How much time do you need to make a trade? You know, if you can make quick decisions, you can use shorter term time frames. If you need a long time to make a decision, you better use longer term time frames or even daily charts where you've got all night to think about it, you know. You've got to work in your execution skills, meaning pushing that trigger. And that's a big thing. You can't sit there, if you're a short-term day trader especially, and ponder over it a long time. You've got to be able to simulate all the information. It's got to pretty much be built in your nervous system. You don't really have a lot of time to think if you're a short-term day trader, a scalper. And you just got to make those quick decisions and boom, execute. And then you've got to also be able to monitor your position, trail your stops, all that stuff rather quickly without pondering it, belaboring it, second-guessing yourself. I mean, all that stuff is death to a trader. I don't care who you study with or what technique you're using or which market you're trading or what interval you're using or which indicators you're using. None of that stuff matters if you don't have the mind game. So anyway, I just shared that because we are going to be getting into some more information. We're adding information to the trading plan, and this you may or may not want to add this in. Okay, try it out. Anytime you try out anything new, and whether it's this or something else, always do it on a simulator. Even if you're trading my methodology with real money and doing well, that's fine. But when you add something new like this, add this stuff on a simulator. Use it on a simulator for a while first. And see, okay, I can handle this. This is good, and this is actually adding to my methodology. This is increasing my probabilities. It's helping my trading. I can handle this information load. This is not too much for me. And you just have to find that out for yourself by monitoring yourself and monitoring your results. Okay? So a little speech there before we get into this more advanced stuff. But really, there's not much more important than what I just talked about. And probably if you've been through enough of my information, through enough of your trading education in general, whether it's with me or somebody else, and you're to this point, you should already know this, but I find a lot of people, they say they know it, and what they really mean is they've heard it before. Okay, there's a big difference between I've heard that before and really knowing, meaning internalizing, meaning acting on it. The real gnosis is having it as part of yourself that you act on. It's actually part of your behavior. And that's what I'm talking about when I say knowing. Okay? All right. So now let's talk about inverted cycles. Now, we don't need to spend a lot of time on inverted cycles. They're actually very simple. And the other thing is they really don't occur very often. They're rather a rare phenomenon. But I want to point them out, and so that when you see them, you may not have even really recognized them before, even identified that anything unusual is going on here, or you may have categorized it in a different way. So I just want to bring it to the forefront of your consciousness, because it is a little different price pattern, and so you're aware of when you see it, and you can have a label for it, kind of put it into a category in your mind. And I'm also going to give you a little warning about them. And well, that's pretty much it. So it'll just take a few minutes here, but here we go. Okay, so we got our Dow E-mini, we got our 5-minute chart. Now here's the deal with this. So what we have is a 3, 4, and the 4 is A, B, C. We get a failed 5. But here is what I mean by an inverted cycle. Okay, ready for this? Notice that the cycle indicator from here to here is going down. So we've got a cycle high here, and we have a cycle low here from our indicator, right? Pretty obvious. High, low, D gets below 55, so clearly cycle low. We also get our notation there. And so we get our F5 here. But what's happening on price? On price, actually what's happening is price is actually going up during this time, isn't it? It's actually going up. See that? So that's what we call an inverted cycle, where the indicator actually goes down to make a cycle high to a cycle low. But price bars, if you look at the highs, I shouldn't have done that. I covered it up with the arrow there, so it's not quite perfectly clear. Let me keep my arrow above the price bars. So you can see it's making higher highs, a little bit higher highs. So price is going up as the indicator is coming down, inverted cycle. Now, that's fine. There's nothing wrong with that. That is still a half cycle. And this goes back to what I talked about in Foundations Course 1 when we introduced the cycle concept. And then I also introduced this indicator and the inputs for this indicator, which are a little special. And I said, now, what you're going to, your mind will just normally assume that what this means is up, down, because that's what the indicator is doing. And I said at that point, that isn't necessarily what's happening. What's really happening is we are using this indicator to measure time, not necessarily up-down movements. Okay, now I kind of let it go at that, and that's all that I said. But here's where that really comes into play. We don't have a down movement here. You know, it's sideways, or, like I say, if you measure the highs of the bars, it's actually up. And yet the indicator comes down. But that is still a half cycle. And so, therefore, this is a great example of how the cycle indicator is just purely measuring time, not necessarily always the up-down movement. Now, as I said at the beginning of this video, these inverted cycles are rare, so indeed, most of the time, it will be showing up-down cycles. But there will be exceptions, and I wanted you to be aware of these exceptions. And these, how do you trade them? You trade them just like any other cycle. So you just kind of ignore the fact that, well, you don't ignore the fact, I shouldn't say that, but with regard to trading it, your entry would be basically the same. So if we bring up our crosshairs, you know, you'd look for the first hook on K, and you would enter above the bar that created the hook on K. So same thing. Now this only comes down to the middle of the range, and that is pretty common for these inverted cycles. And of course that makes sense. It's going to, since the price really isn't coming down at all, and it's actually going up, it's not going to be normal for K to get all the way down to 20. So whether you actually want to trade these or not, that's to your discretion. Generally, the way that we interpret this price pattern is that it's a strong price movement, that the market is in a down half cycle, but price doesn't go down, indicating remaining strength in the market. And so that's why you may, this is another one of those exceptions, where can I trade when the cycle, in what situations can I trade if the cycle indicator only comes halfway down the range? This is one of those cases where you may say, okay, market's doing an inverted cycle, that means strength, so I think I might want to go ahead and take this trade as long as everything else aligns. Acknowledge still where you are in the context of the chart. That again always holds true. This is a second retrace in the trend, so ideally we would have entered in down here actually, where we had our lowest low in this retrace, and K did get down below 20. But if you didn't, you could try to get in here. Just realize that the fifth wave is coming up soon, and so that would be the expected end of the trend, or that's the probability of where the trend would most likely be ending. So this does not, just because there's strength here, that means it's only a short-term indication. In other words, that half cycle is all that it's worth. You determine its long-term worth based on which wave count it comes in. This is in the first retrace in the trend, or the second retrace in the trend, or after that. Okay, now something else I need to show you, to kind of warn you about. Let's get this crosshair off of here. There we go. Okay, let's move to a different point on the same chart. All right. actually, before we get to the warning, I wanted to show you a different type of example. So the last example, we showed a trend continuation pattern with an inverted cycle. Okay, so here we also have an inverted cycle. Cycle indicators coming down, but during that time, price goes up. Okay, so same kind of thing. Now this time, though, its trend is down, but what happens is we get above that 15 EMA. And remember, when we get above that 15 EMA, then the 15 EMA becomes support. We get into our pinball pattern. And so then that actually becomes, it's showing, some strength here to the upside, potential shift of energy from down to up. So it can either occur with the trend or against the trend, and that's what I wanted to point out here before we get to our next chart, which is our warning chart. Okay, so here's a little bit of a warning, a couple things that we can look at here. So we've got our cycle indicator coming down here. Now, sometimes you can look at this, and as we're going, let me move it back a little bit. Like right in here, it looks like price is going up, and it is. So it kind of looks a little bit like an inverted cycle. On the other hand, you have a high there. So this type of pattern is not really considered an inverted cycle because you've got this high marked here. So I just want you to be aware of this to remind you that the low on K doesn't necessarily line up, or the high of K doesn't necessarily line up to the bar with the high or low of the cycle. The bar marks the real cycle high and low. So this is the cycle high, and so therefore don't look down here and then say, oh wait, now price bars are moving up as the cycle indicator is coming down. Okay, that would not be considered an inverted cycle. This cycle overall, this pattern overall, because that's the high, is still down. Now what actually, and the other thing that you would want to look at is, again, we're at a 5-wave pattern here already. So there's no magic. Again, the temptation everybody keeps falling back into is taking one thing that they learn, like an inverted cycle, and then they just think, okay, I'm just going to trade that. Well, you can't. Remember, no one thing has any great probability associated with it. You've got to trade it in the context of the other things. So therefore, an inverted cycle by itself, again, is meaningless. And what will happen sometimes with inverted cycles, too, is they just turn into sideways movements. And they just go sideways for a while. So that's why you have to take them in the context of all the other energies. An inverted cycle in itself, yeah, generally we read it as a holding up of the strength of the market, but again, that's just one indication. Then you got to look at your support resistance, where you are in the wave count, next higher time frame, all that stuff.